The allure of quick trades is strong in the stock market. Market orders often appear like the magic button to achieve this speed. Just click, and you're in the game. But as with many things that seem too easy, magic often has a hidden price. Many new investors and even some experienced ones learn this lesson the hard way. They see a stock price moving, feel the urge to act and jump in without fully considering the mechanics of their entry. This impulsive action can sometimes lead to less than ideal outcomes. A market order is very similar to telling your broker, "Get me that stock, right now, at whatever the prevailing price is." You are essentially agreeing to accept the current market price, whatever that may be, when your order actually hits the exchange. This approach can be perfectly fine in certain situations, but it carries inherent risks in others. The main challenge with relying on the current price is that this price can be a surprisingly elusive and rapidly moving target. The price you see displayed on your trading screen might not precisely be the price at which your trade is executed. This discrepancy, even if it seems minor on a per-share basis, can accumulate and make a noticeable difference to your investment capital over time. Smart, experienced investors understand this and learn to look beyond mere speed, valuing control just as highly. So, while market orders undoubtedly promise the gratification of instant execution, they can also, if used without caution, lead to instant regret. Knowing the difference between various order types, like market orders and limit orders, is as fundamental as a carpenter knowing how to use a hammer versus a screwdriver. Making the informed choice about which order type to use is a significant step towards becoming a smarter, more effective trader. Let's begin by breaking down the absolute basics of these trading tools. A market order is perhaps the most straightforward type of order you can place. When you issue a market order, you are instructing your broker to buy or sell a specific stock as quickly as possible. The broker then executes this trade at the best available price currently prevailing in the market at that exact moment. With a market order, you are virtually guaranteed that your order will be filled, assuming there's enough trading activity in that stock. Speed and certainty of execution are its primary defining advantages. If your goal is to enter or exit a position without delay, a market order will achieve that. Imagine you find yourself at a bustling farmer's market on a Saturday morning. You've decided you want to buy some fresh apples. You approach a vendor and say, "I'll take a kilogram of your best apples, whatever the going rate is today." This scenario is a perfect, real-world analogy for a market order. You will definitely get your apples. However, the price per apple might be slightly higher, or perhaps even a little lower, than the price you might have seen advertised just a few minutes prior. In this situation, your priority is acquiring the apples promptly, rather than haggling to secure a very specific price. Now let's contrast this with a limit order, which operates on a different principle. A limit order provides you, the trader, with a much greater degree of control over the transaction price. You effectively get to name your price. Market orders, despite their apparent simplicity, harbor a potential hidden catch known as slippage. Slippage occurs when the actual execution price of your trade differs from the price you anticipated when you initially placed the order. This phenomenon is particularly common in markets that are moving very quickly, or when you are trading stocks that don't have a large volume of buyers and sellers readily available. The market price for a stock can fluctuate multiple times within the span of mere milliseconds. Let's consider a practical example to illustrate this. Suppose you are observing XYZ Corp stock, and it appears to be trading at $10 per share on your screen. You decide to buy 100 shares and place a market order. However, by the time your order travels through the electronic networks, reaches the stock exchange and is matched with a seller, the best available price might have inched upwards to $10.05 per share. Consequently, you end up purchasing the shares at $10.05 each instead of the $10 you expected. That small difference of 5 cents per share is what we call slippage. For an order of 100 shares, this slippage amounts to an additional cost of $5. It might seem like a trivial amount, but these small sums can significantly accumulate over many trades. It's important to understand that this slippage can work against you regardless of whether you are buying or selling. The "get me in now or get me out now" mentality, while understandable in moments of market excitement or panic, can prove to be quite costly. Furthermore, especially when dealing with large volume orders, market orders themselves can significantly influence the stock's price. Limit orders stand out as the intelligent trader's preferred instrument for achieving precision in their transactions. They effectively place you in the driver's seat, granting you substantial control over the price at which your trades occur. With a limit order, you are the one who dictates the absolute maximum price you are prepared to pay for a stock if you are buying, or the absolute minimum price you are willing to accept if you are selling. This inherent feature of limit orders elegantly eliminates the unwelcome surprise of negative slippage. You enter the trade with full knowledge of the specific price point you are targeting. This level of control is an incredibly valuable asset in navigating the markets. Let's illustrate this with another example. Imagine you have conducted thorough research on ABC Inc., and your analysis leads you to believe that it represents a good value investment at $50 per share, but you are not keen on paying any more than that. Currently, ABC Inc. is trading at $50.50 per share. In this scenario, you can place a limit order to buy 100 shares of ABC Inc. specifically at a price of $50. Your order then enters the market system and patiently waits. If and only if the market price of ABC Inc. subsequently drops to $50 or even lower, your order will be triggered and, market conditions permitting, filled at $50 or potentially an even better price if the stock price experiences a rapid further decline. The crucial element when utilizing limit orders is often patience. It's important to accept that your limit order might not be executed immediately. If the stock's market price never actually reaches the limit price you have specified, your order will remain unfilled. However, this is the inherent trade-off. In exchange for the risk of non-execution, you gain invaluable price protection. Cryptocurrencies have gained widespread notoriety for their exceptionally wild and often unpredictable price swings. It's not uncommon for a digital coin to surge by 10% in value one minute, only to plummet by 15% or more in the very next. In such an extraordinarily volatile trading environment, employing market orders can be akin to playing with fire, potentially leading to significant and unexpected losses. The price you observe on your trading screen for a cryptocurrency can be vastly different from the actual price you receive by the time your market order navigates the system and gets executed. This discrepancy, or slippage, can be quite substantial in these markets. Imagine you're eager to purchase a newly launched cryptocurrency that's generating a lot of buzz and excitement. There's a palpable sense of hype surrounding it, and as a result, its price is jumping around erratically. If you were to place a market order in this kind of frenetic situation, you run a very real risk of inadvertently buying at the absolute peak of a sudden, short-lived price spike. This could mean you end up paying a considerably higher price than you had initially intended or budgeted for. Slippage in cryptocurrency markets, particularly during periods of high volatility or for less liquid coins, can be notoriously brutal. Limit orders, in stark contrast, offer a much-needed shield of protection when navigating these turbulent crypto waters. By carefully setting a limit buy order, you clearly define the absolute highest price that you are prepared to pay for a particular cryptocurrency. If the coin's market price then surges aggressively past your specified limit, your order will simply not execute. This mechanism effectively protects you from inadvertently buying at an excessively inflated price during a speculative frenzy. Similarly, when you're looking to sell, a limit sell order ensures that you do not offload your crypto assets for less than your predetermined target price during a sudden, sharp market dip. Let's clearly lay out the advantages and disadvantages of market orders and limit orders side by side to facilitate a better understanding. Market orders are fundamentally characterized by their speed and the high certainty of execution they offer. If you find yourself in a situation where you absolutely must buy or sell a stock right now, without any delay, then a market order is generally your most reliable choice. It will almost invariably get filled, provided there is sufficient liquidity in the market for that particular stock. This makes market orders particularly suitable for trading highly liquid stocks, such as well-known blue-chip companies where the bid-ask spread is typically very narrow, thereby minimizing the potential for significant, unfavorable slippage. However, the most significant drawback associated with market orders is the inherent price uncertainty. When you use a market order, you effectively relinquish control over the exact execution price of your trade. Slippage, as we have extensively discussed, can unexpectedly erode your potential profits or inflate your actual costs. This risk is magnified in fast-moving markets, or when dealing with stocks that are less liquid and have wider bid-ask spreads. Furthermore, if you are attempting to execute a very large market order, you might inadvertently move the market price against your own position before the entire order is filled. Limit orders, conversely, shine brightly when it comes to providing excellent price control. You are the one who sets the terms of the trade by specifying your desired price. This crucial feature acts as a safeguard, protecting you from the risk of paying more for a stock than you intended, or from selling your shares for less than you deemed acceptable. Limit orders are a fantastic tool for implementing disciplined trading strategies and for entering or exiting positions at precise price levels that you have identified through your research and analysis. The primary drawback of utilizing limit orders is that there is absolutely no guarantee that your order will be executed. If the market price of the stock never actually reaches the limit price you have specified, your order will simply remain unfilled in the order book. As a consequence, you could potentially miss out on a profitable market move if you are overly conservative or unrealistic with the limit price you set. Understanding the specific scenarios in which to deploy each order type is absolutely key to effective trading. You should generally consider using a market order when the speed of execution is your paramount concern and the inherent risk of significant slippage is relatively low. For instance, if you are trading a very liquid stock, such as shares of Apple or Microsoft, and your intended order size is comparatively small in relation to the stock's average trading volume. The bid-ask spread for these types of highly traded stocks is usually very tight, often just a penny or two. Therefore, the price at which your market order gets executed will likely be very close to the price you observed on your screen. Market orders can also prove useful if you find yourself needing to exit a position very quickly, perhaps in response to some unexpected breaking news or a sudden shift in market sentiment. In such urgent situations, your primary concern might be to liquidate your holding immediately, rather than attempting to squeeze out every last possible penny of profit. However, even in these scenarios, it is crucial to remain mindful of the prevailing market volatility. During periods of market panic or extreme price swings, market orders can unfortunately lead to very poor fills, as prices can gap significantly. Sometimes a marketable limit order, which is essentially a limit order placed very close to or slightly through the current market price, can offer a slightly safer alternative for a quick exit. Limit orders, on the other hand, are generally your most reliable and advantageous companion in most other trading scenarios. They are the preferred tool when you have a specific target price in mind for either entry or exit, a price that you have determined based on your thorough fundamental or technical analysis. You should definitely use limit orders when you are trading stocks that are less liquid, or during times of heightened market volatility, as this will help protect you against the potentially costly effects of slippage. Furthermore, if you are planning to place a large order, limit orders are almost always the more prudent choice to avoid significantly impacting the market price yourself and causing self-inflicted adverse price movement. For long-term investors who are looking to gradually accumulate a position in a particular stock over an extended period, limit orders are an excellent strategic tool. To truly harness the full power and benefits of limit orders, it's essential to set realistic prices for them. Avoid the temptation to place your buy limit order too far below the current market price, or your sell limit order excessively far above it, in the faint hope of catching a miraculous, extreme price fluctuation. While you might occasionally get exceptionally lucky with such an approach, you will far more often find that your orders go unfilled, causing you to miss out on perfectly viable trading opportunities. Instead, take the time to look at the stock's recent trading range, identify key support and resistance levels on its chart, and if possible, examine the order book to gauge a reasonable and achievable level for your limit order. A very effective strategy is to use limit orders not just for entering positions but also for exiting them in a planned manner. When you purchase a stock, consider immediately placing a sell limit order at the price level where you intend to take your profits. This is commonly known as a take-profit order. Simultaneously, you can also place a stop-loss order, which can be a stop market order, or, for more price control on the exit, a stop limit order, to define the maximum loss you are willing to tolerate on that trade. Utilizing limit orders for your exits helps to automate your predefined trading plan and, crucially, removes a significant amount of emotion from the critical selling decision, which can often be clouded by fear or greed. If your trading platform provides access to level 2 quotes or the order book, make it a habit to pay close attention to it. The order book displays a list of the current buy limit orders, bids, and sell limit orders, asks, that have been placed by other traders in the market, along with the volume of shares at each price level. This information can provide you with valuable insights into the current supply and demand dynamics for the stock at various price points. It can help you make a more informed decision about where to strategically place your own limit order to enhance its probability of being filled without having to chase the price too aggressively. Understanding this market depth is a skill that develops with practice. Finally, remember that patience is indeed a virtue when working with limit orders. Sometimes your carefully placed order will fill remarkably quickly, perhaps within minutes or even seconds. One of the most common mistakes, particularly for traders who are new to the markets, is the aggressive use of market orders during periods of extreme market volatility or when dealing with stocks that are illiquid or thinly traded. They might see a stock price moving very rapidly, feel a sense of urgency or fear of missing out, and hastily jump in with a market order. All too often, this results in them receiving a terrible fill, with an execution price far from what they initially saw on their screen. This is akin to impulsively chasing a speeding car on foot. You are highly likely to stumble or get an unfavorable outcome. Always take a moment to assess the current liquidity and volatility of a stock before reflexively hitting that market order button. Another frequent error encountered when using limit orders involves setting them either too tight to the current market price or, conversely, too wide. For example, setting a buy limit order just a single penny below the current ask price in a fast-moving upward trending market might mean that you consistently miss getting your order filled as the price moves away too quickly. On the other hand, setting your buy limit order too far away from the current market price, hoping for a deep pullback, may result in it never being reached, causing you to miss the entire trading opportunity. Forgetting about open, working limit orders is a surprisingly common pitfall that can lead to unexpected situations. You might place a limit order to buy a particular stock at a price significantly lower than its current trading level, then shift your focus to other opportunities and forget that the order is still active. Weeks or even months later, the market could experience a sudden dip, triggering your forgotten order. You might then find yourself suddenly owning shares in a company you weren't actively considering at that moment, potentially disrupting your portfolio allocation or cash balance. It is crucial to always keep meticulous track of all your working orders. Make it a regular habit to review your open orders and cancel any that are no longer aligned with your current trading strategy or market outlook. Ultimately, choosing the right order type for each specific situation is absolutely fundamental to achieving your trading goals, and most importantly, protecting your hard-earned investment capital.